What's up, everybody? Welcome back to my channel, Mortgages with Mike D. If it's your first time here, you're new to the channel, I am a licensed mortgage advisor, and the goal of this channel is really just to help current homeowners and potential future home buyers really better understand the ins and outs of what can sometimes be a complicated mortgage process. So anything I can do to help just make you better informed, that is what the ultimate mission is here at the channel. So in today's video, we are going to be talking about what PMI is, when it goes away, and is it necessarily worth it? So before I dive in, please remember to like, subscribe to the channel if you find any value, would mean a lot. And without any further ado, let's dive into today's content. So PMI stands for Private Mortgage Insurance, and it's required by lenders when a buyer generally puts down less than 20% on a conventional loan. This exists to protect the lender, not you, the consumer. Don't get that confused. And basically, think about it in this way. Since you're putting less money down and, in a sense, have less skin in the game, the lender wants that additional protection in the event, worst case scenario, that you default on your mortgage payment. So they'll be protected by taking out this insurance policy, basically. So how is the private mortgage insurance paid? How's it structured? So simply put, it's pretty straightforward. It's paid on a monthly basis as part of your regular mortgage payment. So you'll have your principal and interest, your PMI, and your taxes and insurance. So every month your lender will collect that on your behalf. So that leads to the question, well, how much is the PMI? You know, it's another additional cost to home ownership. So let's explain how much this can be. So it can really be as low as, in the $20 per month range up to $100 or even a couple $100 a month. So you're probably saying, well, geez, that's a pretty wide range. How can I estimate what I will expect to pay? That's a good question. There's a lot of calculators online, mortgage calculators, which will give you the option to enter the PMI. In the description, I even have my own mortgage calculator on my website, which will basically have like a percentage or a fixed rate, so it will automatically calculate what that PMI is. It's probably going to be a little conservative, but it will still give you a rough idea of what you can expect. So what goes into calculating what that PMI payment's going to ultimately look like? So it's kind of similar to how your interest rate is computed. And what I mean by that is they're looking at your credit score. So the better your credit score is, the better. They're looking at your loan size and down payment. So again, as I said, if you put 20% down, you don't have PMI. So the closer you are to 20%, the less the PMI is going to be. The less money you put down, the higher the PMI is going to be. And then the loan size. If you have a $100,000 loan, the PMI is going to be not as significant. If you have a $400,000 loan or even more, the idea is the PMI is going to be a larger cost. Another factor can be the number of borrowers on the loan. It might not be as a significant component in determining the PMI score, but basically if there's one borrower versus two borrowers, lenders like more people that are obligated to be responsible for the payments in the event that you do go default. So you might get a bit of a break if there's more than one borrower on the loan. Now, another important question is, does PMI last forever? Or if not, when does it go away? So the first question is no, PMI does not last forever. It's not going to be on your loan for the life of the loan. It actually will eventually automatically be terminated. A common misconception, however, is the PMI is automatically removed once you hit 80% loan to value, or also known as you've accumulated 20% equity. And that's untrue. So that would make sense though, right? Because as I said earlier, if you were to put 20% down when you purchased the home, you would not be subject to this PMI. So why wouldn't it automatically be removed once you've reached that milestone? So the reason is because, let's say, from the time you purchased until the time you've paid your balance down to that point of 80% loan to value, let's say real estate values went down since then. In that case, you wouldn't necessarily be at 80% loan to value. You might really be at 82, 83, or whatever the case may be. So what happens is once you think that you reach that milestone, you can contact your lender, okay? And it can be for a variety of reasons, right? One being you paid your balance down over the years and now you think you've reached 80% loan to value, or what we're seeing in the market currently is real estate values just soaring and skyrocketing at historic paces. So you're probably hitting that range much sooner than you originally anticipated. So you can contact them and just let them know, hey, we believe based upon what our outstanding loan balance is versus the current market value of our property, that we've reached or exceeded 80% loan to value. We have more than 20% equity. So, we would like to request the removal of the PMI. So the lender will likely require an appraisal because essentially they want to ensure that the value didn't decline. So we're not always going to be in a market like we are currently where prices are up and up. There's going to be some times where we are going to see some dips or some flat kind of movement. So in those cases, that's why they require the appraisal, again, to protect themselves, to ensure that the value is in line with the 80% loan to value. You might be thinking, well, what if I forget to contact them or the appraisal doesn't support what our beliefs are? Do I have to go through this process again? The answer is, if the appraisal doesn't support your value or your belief what the value is, yes, you'll continue to pay the PMI, but until when? So the PMI is automatically terminated once you've reached 78% loan to value, or in other words, you've accumulated 22% equity. So it might be an additional year and a half, 2 years, depending on the situation. But either way, there's rules in place where you're not going to end up paying this forever. So you will see that eventually fall off once you at least hit the 78% loan to value. You won't need an appraisal. It's going to go based upon the loan balance at the time versus the property value from when you purchased the house. So finally, is PMI bad? Is it worth it? And ultimately, it's really subjective to kind of your goals and timeline with the specific property. In short, PMI is not bad. And in a future video, we can kind of dive into a more detailed analysis of showing you why it can be worth it to have this additional expense. But on a more general sense, I want to give you a couple of reasons to explain why PMI shouldn't be viewed in a negative light. Number one, let's be honest, it can take quite a while to save up that 20% down payment. Even in today's market, as I mentioned before, we're seeing real estate values soar at historic paces. So, for example, just last year, what you thought 20% would be on a home is no longer the case. So now you have to save even more because values are increasing. So 20% is going to be greater than what you thought 20% was a year ago. I mean, even a couple months ago. So it can just be like this never-ending cycle. Obviously, prices at some point will stabilize, but the point is you're going to be playing catch-up for a bit until you accumulated that 20% down payment. Additionally, number two, there's what we call a cost of waiting. Really, with anything in life, there's going to be some sort of cost of waiting. And what I mean by that is interest rates can rise by the time you're waiting to save that 20%. Home prices can rise, as I just noted, as you're waiting to save that 20% down payment. And then, not to mention, if you're renting, right, you're going to be paying rent every month, which is another cost to consider. And especially right now, we're seeing rents like real estate values rise at historic levels, and it's making it tougher and tougher for potential home buyers not even save 20% down, but just enough for the minimum down payment, just because it's tough to save money when your rent continues to increase and increase and increase. Another reason is the longer you wait, you're missing out on a lot of the benefits that come along with owning real estate. For instance, you're missing out on just accumulating equity in the property, which leads to your growth in your personal net worth. So again, I sound like a broken record, but as real estate values have been skyrocketing, you're missing out on the benefit of improving your net worth and growing your equity in the home. Not to mention, every month when you make your every month when you make your mortgage payment, a portion of that is going towards your principal. So not only are you seeing the values go up, but then every month you're going to be slightly paying off that principal pay down. So again, that leads to improving your personal net worth. And I would say a final reason, kind of statistics and mathematics aside, it's just really the peace of mind of getting into a home. For a lot of people, it's a top priority, it's a major goal, and really just getting that house before waiting to save the 20% down could just be a huge weight off your shoulder. There's other reasons too. There's tax benefits, there's a variety of benefits, but there are the four, I think, that I just wanted to highlight. So I hope this video was helpful. Like I said, we can dive into a future video where I kind of give a more in-depth analysis. I didn't want to drag this video too long. I just wanted to kind of get the basics across to help you better understand PMI and the significance of it. So I hope you enjoyed this video. Again, please do me a huge favor, give me a like, a thumbs up, and subscribe to the channel. And I hope to put more useful content out to you in the future. Thank you again, and we'll see you on the next one.